Hello guys, welcome back to my channel. Don't forget to like, share, comment, and subscribe. Asian shares slipped on Monday and the dollar extended its climb amid aims over global growth as most central banks keep raising rates, while a modest easing by China served only to highlight troubles in its property market. U.S. Federal Reserve Chair Jerome Powell headlines a host of policy markers at Jackson Hole later in the week, and the risks are that he will not meet investor hopes for a dovish pivot on policy. We expect a reminder that more tightening is needed, and there is still a lot of progress to be done on inflation, but no explicit commitment to a specific rate hike action of September, said Jen Neferzy, an analyst at NetWest. For markets, a bland delivery like that could be underwhelming. Future futures are fully priced for another hike in September, with the only question being whether it will be 50 or 75 basis points. Rates are seen reaching 3.5% to 3.75 by year end. A Reuters poll of economists forecast the Fed will raise rates by 50 basis points in September, with the risk skewed towards a higher peak. One expectation to the tightening trend is China, where the central bank trimmed some key lending rates by between 5 and 15 basis points on Monday in a bid to support a slowing economy and a stressed housing sector. Unease over China's economy tipped the yuan to a 23-month low, while pressuring stocks across the region. FSCI's broadest index of Asia-Pacific shares outside Japan fell a further 0.6%, though China's blue chips did manage to gain 0.7%. South Korea's Kospi said 1.3%, while Japan's Nikkei fell 0.5%, though it has drawn support from the recent sharp reversal in the yen. Eurostoxx 50 futures lost 0.2% and FTSE futures 0.1%. S&P 500 futures is 0.5% and Nasdaq futures 0.6%. The S&P 500 has repeatedly failed to clear its 200-day moving average around 4.320 and ended last week down 1.2%. Both fast Select's survey of investors found most were still bearish, though 88% did expect lower inflation over time, the highest proportion since the financial crisis. That helps explain this month's rotation into equities, tech and discretionary, and out of defensive, said BofA strategist Michelle Hartnett. Relative to history, investors are still long defensives and short cyclicals. He remained a caution bear given rising interest rate and recommended fading future S&P release above 4.328. Equity valuations were not helped by a steep rise in global bond yield last week. British 10-year yield climbed by the most in 5 years following a shock inflation report, while bond yields jumped on a sky-high rise in German producer price. 10-year Treasury yield rose 15 basis points over the week and last stood at 2.98%, while the curve remained deeply inverted to reflect the risk of recession. The general air of global uncertainty has tended to both the U.S. dollar as the most liquid of safe havens, leaving it up at a basket of currencies. Last week, it jumped 2.3% in its best performance since April 2020. Okay, maybe it's from me. Thank you for watching. Don't forget to like, share, comment, and subscribe.